기술주들이 시장의 흐름을 주도하고 있는 시점에서 많은 분들이 전통적인 가치 투자 방식이 더 이상 시장의 설명력을 잃은 것은 아닌가라는 의구심을 좀 품기 시작했는데요. 그래서 이 시점에서 한 번쯤은 기업의 본질적인 어떤 경쟁력을 중요하게 생각하는 모트, 흔히 말하는 경제적 해자라고 하죠. 이런 경제적 해자 투자 철학에 대해서 조금 알아보면 좋을 것 같아서 오늘 모닝스타의 전문가분을 모시고 좀 이야기를 나눠보고자 합니다. So Andrew, can you introduce just a little bit about yourself to the Korea audience?
Absolutely. Hi, my name is Andrew Lane. I'm a member of Morningstar's equity research team. I've been a member of this team for about 11 years, and my main role is to take the research and data points produced by the Morningstar equity research team. We have a team of about 100 equity analysts and use them to create unique indexes, much like the Morningstar Wide Moat Focus index that we'll be talking about today.
Yeah, so let's just maybe then dive into the subject right away. So can you explain the concept of moat and why it is important for investors to consider?
Yes, so the economic moat methodology is central to our research process. And so an economic moat, in our opinion, is a durable competitive advantage that helps protect a company's profits and keep competition at bay. Warren Buffett was the first to use the phrase economic moat, and so we certainly use it as part of our research process. So there are 5 kinds of competitive advantages or economic moat sources that a company could have: intangible assets, cost advantage, switching costs, network effect, and then efficient scale as well. So those are sort of the forms of competitive advantage that we're looking for when we research a company.
Sure, but then moat is quite widely known concept among the investors. So what sets Morningstar moat research maybe apart from others in the industry?
Our opinion about an economic moat is that it measures the quality of a company. And where it's very different from the traditional sense of quality as a factor is that it's forward-looking. And so it's subjective. It's based on research, and we're trying to determine how long a competitive advantage might last into the future. And so I'll give a very quick example there. When Amazon first became a publicly traded stock, it was loss-making at the bottom line. And so for quite some time, Amazon would have scored very poorly on the traditional quality factor metric, and it may not have been held in quality-based strategies. With our moat methodology being forward-looking, from right away, we were able to tell that Amazon had a very bright future, and even though it might not have been all that profitable at the beginning, it had a wide moat rating very early on and was a good performer in the wide moat focus index. So that's the importance of that forward-looking element that makes our approach unique.
A question just pops out. So how do you actually apply that forward-looking approach? Is it like a research analyst's opinion in it, or is there any like a scoring system or models that you guys have?
Yes, absolutely. So as the analyst at Morningstar starts to research the company, he or she starts to build an opinion, a subjective, research-based opinion about what economic moat rating a company should have. So for every company we cover, we would assign a no moat rating, a narrow moat rating, or a wide moat rating. Once the analyst has an opinion about which of those is appropriate, we have a committee that provides quality control and tries to make sure that our moat methodology is applied consistently across all of our coverage. And so in order to publish an economic moat rating, the analyst has to convince that committee that his or her arguments are well substantiated and that the moat rating he or she wants to assign to the company makes sense and is consistent with that methodology.
So it's not just one analyst's opinion, it's like the whole team's opinion has to say that it has a wide moat, then it gets the moat rating.
Correct. So the Economic Moat Committee that approves the moat ratings that we assign, it's about 20 of our most experienced analysts. It's the analysts who are most familiar with the methodology, who have been using it for the longest amount of time. And it's really from that group of experienced analysts. They provide the oversight as to what moat ratings ultimately get published and impact stock selection for strategies like the Wide Moat Focus Index.
So then how does that Morningstar Wide Moat Focus methodology, how does it actually work, the process?
Yes, certainly. And so we cover about 1,600 companies within the Morningstar Equity Research Group. And so we're actually the largest independent equity research provider globally. And so that's the selection set. When we start with that group of stocks, the first step is to screen for U.S. companies. This is a U.S. equity strategy.
Sure.
That gets us down to somewhere around just over 700 U.S. securities that our analysts cover. The next step is to screen for just those companies with a wide economic moat. And because that's really what we're looking for. We're looking for the companies with the strongest competitive advantages that will prove most durable. That gets us down from a little over 700 US stocks to about 150. And so that's really the stocks we're picking from. But then there's one more step that's important as well, and that's a valuation screen, right? So just because a stock has a wide moat does not mean it's automatically a great investment opportunity. You know, a lot of wide moat stocks are expensive by various valuation metrics. So we take all the US wide moat stocks we cover and we rank them by the degree to which they're trading below what we think they're worth.
So undervalued.
Yes, the most undervalued US wide moat stocks, and that gets us to usually a portfolio right around 50 holdings or so. So again, we start with 1,600 companies that we research and cover and rate, and we end up, after those screens are applied, getting to about 50 stocks in the portfolio.
Sure. So the 150 wide moat stocks, so
Yes.
150 is the stocks that are considered to have wide moat.
Yeah, so
But
about 150 US stocks have a wide moat rating.
And
Yeah.
then you narrow it down to 40 to 50 based on the valuation. So I think there should be a lot of collaboration between the index team and the research team. So could you just elaborate a little bit more?
Absolutely. So there's a great deal of collaboration between the Morningstar Equity Research team and the Morningstar Indexes team. And really the best way to think about it is that the equity research team provides the research and the data points that ultimately determines stock selection based on the index construction methodologies that the indexes team creates. And really how it works is the index team creates the rules that determine what stocks go into the Wide Moat Focus Index at any given point in time. The index is reconstituted quarterly and also rebalanced quarterly. And really, it just takes a snapshot of the ratings we have on all of the stocks that we cover, and through the rules-based index construction methodology, that determines what stocks go in and come out, and what the appropriate weightings are for those holdings.
Great. So I think it's interesting that it's like a combination of passive and active, like in terms of the research analysis is incorporated into the index. Am I understanding correctly?
Absolutely.
Okay.
So certainly there's a passive element, and that's in the form that this is a rules-based index. So there really is no portfolio manager saying, I like that stock, or I don't like this one, or hey, I think it feels like the right time to be underweight energy or overweight industrials. The portfolio construction rules really determine what stocks are going in and coming out. So that's the passive element. But I would really stress the importance of the active part of the process, and that's just that it's all based on forward-looking, research-driven data points from the equity research team. So their main job is to think about the future of a company. How will its competitive advantage change? What cash flows will the company generate? And ultimately, it's that research that's the main key component of stock selection for this strategy.
So actually, I just want to mention about this one stock. So Nvidia, it is believed to have a wide moat regarding their dominant market power and their technological superiority. So that like no company actually could take over easily within a few years. But then, if I'm correct, it was removed from the wide moat index because of the excessive valuation, right?
Yes.
If I'm correct. So, but then, like since then, it has experienced like a tremendous growth afterwards.
Tremendous.
So, my question is, wouldn't it be like fine to hold on to a company with a wide economic moat because it has ongoing competitiveness? But then, why does Morningstar think the valuation aspect is considered so crucial?
Certainly. So there's no stock I'm asked about
Sure.
more often than NVIDIA,
Sure,
of course.
everyone's talking about it.
And rightly so. I mean, the story has been incredible. The performance of the stock has been
Crazy.
hard to believe, but it truly is an unbelievably innovative company that is very well positioned, particularly for the future of generative artificial intelligence. So NVIDIA, just to start with, is a company that we love. We think it's a fantastic business model in terms of manufacturing GPUs, which are critical to underpinning large language models and offering generative AI capabilities. Broadly, NVIDIA has a massive lead or head start on any competitors. So it is really, at this point, the only game in town for some of those really advanced GPUs that are in high demand. Definitely a wide moat company, very strong intangible assets, some switching costs as well there. And so don't get me wrong, we love the business model. The only reason it is not a holding in the Wide Moat Focus Index, which you mentioned, is valuation. So we think that the stock is trading a little bit higher than what the fundamentals of the business really justify, or then we could really substantiate.
I think everyone would agree on that, actually. So then, can you share any interesting stories about specific companies within tech companies?
I'll start by saying that right now, the biggest underweight by sector in the index is technology.
Yeah.
And that's not always the case. So as recently as the end of 2022, after a rough year for the technology sector in that year, we actually saw a lot of opportunities from a valuation perspective in tech. And as a result, we were overweight at the end of the year in 2022. But then, of course, over the course of 2023, tech stocks in the broader sector performed so well that we just were having a harder and harder time finding what we felt were undervalued tech stocks. And a lot of that has to do with the emergence of the theme that everyone's talking about right now, which is artificial intelligence. A lot of these tech companies are claiming that they're going to be huge winners from the AI theme, and certainly there will be some big winners. But we would argue that many of the companies claiming that AI is going to, significantly increase their profits may not have that much of an impact at all, right? AI is going to be widely adopted, and so most of the companies that have traded a lot higher on the notion that AI will help their profitability and increase shareholder returns, we'd be a little bit skeptical. And so that's a theme that I think generally, broadly across the tech sector has that sector trading a little bit richly right now and above what we think is appropriate.
We talked about the performance, and how did this index actually perform in 2024 relative to the broad market?
Yeah, certainly. And if you don't mind, I'll zoom out just a little bit at first. This is an index that launched in February of 2007. So it has been around for over 17 years at this point, and it has and none of that's back tested. That's since it actually went live. And over that period, it's outperformed the broader U.S. equity market by about 3 percentage points annually.
Annually?
Annually, yes. And so, of course, as sort of a large core strategy, it's very difficult to outperform the S&P or large cap benchmarks over a long period of time. So it's a long-term track record that we're very, very proud of. But of course, with any active strategy, there are periods of great outperformance and periods of underperformance. So of course, year to date, the strategy has underperformed the broad U.S. equity market by a fairly wide margin. That's really due to two main reasons. The first is that it's an equal weighted strategy. And so when you have the large and mega cap stocks like the Magnificent Seven performing very well, driving a big share of the broad market's returns, equal weighted strategies like the Wide Moat Focus Index tend to underperform. So that's been the biggest headwind year to date, is just simply the weighting mechanism. The other headwind is something that we just talked about, which is not owning NVIDIA. It's very rare that owning one stock or not owning one single stock would have this amount of impact on relative returns. But the rise of NVIDIA has been so dramatic that not holding it this year has been a very significant headwind to performance.
But then, I think it's quite unfair to compare, wide moat index to the broad market when only one or two stocks has actually, driven the whole market.
Yes,
So,
and that's one of the benefits typically of the equal weighted approach is that it's unusual for one single stock, whether it's being overweight that stock or underweight that stock, would have this amount of impact on the performance of the portfolio as a whole. The experience with NVIDIA has been rather unique simply because it's just simply performed so well. And its weighting in the broad market has risen so dramatically in such a short period of time that it's a unique experience.
yes, I mean, this is very unique time. But then, how about like in the past? Like, when it outperformed the broad market? What was the market like?
Sure.
Like that?
Yeah, and so this is a really unique strategy because it's sort of neither defensive nor cyclical. It actually, over the long term, has performed well both in down markets, but also when the market has rallied. And so if we go all the way back to when it launched in February of 2007, and we look at quarterly data, the down capture is attractive at about 86. So it's held up much better than the broad market in a quarter when the market's moved lower. But typically, when you see a good down capture ratio, you might not get full participation when the market rises. And in fact, the Moat Index has also outperformed when the market has risen as well. So its upside capture is right around 108. So certainly it's preserved capital when we've had downward market movements, but that doesn't mean it hasn't performed well to the upside as well. If I could add one more point, I think the reason that we've been able to hold up well to the downside while also outperforming the upside, when you have years where the broad market falls, whether it was the financial crisis, 2018, the U.S. equity market was down, 2022, the U.S. equity market was down over 18%, we start to be able to find bargains more often, right? Stocks trading at a discount to fair value that we might not normally see. And so we can take advantage of those not just in that year, where the market moves lower, but then actually take attractive entry points and outperform in the year to follow as well.
So the valuation part actually works well at that time.
Absolutely.
Maybe. Yeah,
Yes.
I mean, I think it's quite interesting that it performed relatively better than the broad market when the market is actually in the bearish time. And I think this has a really key takeaway point to the Korea investors as well, is that it could provide an alternative options for Korea investors. Like, if everyone's looking about all these NVIDIAs and all the top running stocks right now, you could also maybe alter a little bit of your assets into some less volatile, more stable index strategies that people could use.
Yeah, and I'd love to add one more thought there. I completely agree. For U.S. exposures that have exposure to this index in some sort of product, they often use it alongside broad market exposure. So, for example, if you look at the S&P 500 right now, over 30% of the weighting of that index comes from 7 stocks alone, and those are the Magnificent Seven stocks, of course. And so whether you like it or not, whether you're aware of it or not, if you are, own a product tracking the S&P 500, you're getting a lot of exposure to big tech and a lot of exposure to the Magnificent Seven.
Sure.
And so this is an interesting complement to strategies like that, where you're not doubling down on exposure to big tech. You're not doubling down, as of now, on exposure to NVIDIA. But yet, over the long run, it still has managed to outperform the market. So not only has it performed well relative to the broad market, but it adds a lot of diversification benefits as well when it's paired with broad market exposure.
So why don't we move on to the very last topic that I have. The keyword is evolution of index methodology, moat investing in the new tech era. So these trends, as we have been mentioning throughout a few minutes, these trends, they just emerge and fade, So do you have any trends that you've noticed that investors should be aware of, such as artificial intelligence and everything? And because these trends may produce a very high valuation, so does that kind of hurt index performance?
Yes, very great question. I agree with the part of your question where you said themes or trends, they can emerge and fade very frequently. I would argue that most exciting investment themes or trends that we hear about or read about in financial media, many of them don't have staying power. Certainly some of them do. But by and large, a theme you might hear a lot about one year, maybe a couple years later you don't hear about it at all. Maybe something like the metaverse, for example.
Yeah, metaverse. Yeah.
And I think our methodology is well equipped to really help us determine what themes do have staying power. And it goes back to that forward-looking element that I talked about earlier, right? We're thinking about how competitive advantages might change in the future. To value a company, we're forecasting cash flows long into the future. And we have to think about which themes are emerging and which themes will impact that economic moat or may impact those cash flows into the future. So again, I think we're well placed to determine which themes matter and which ones don't. The themes that I think are most interesting right now, we talked a little bit earlier about generative AI. I would argue that this is a theme that does certainly have staying power. In fact, our analyst who covers NVIDIA, his name's Brian Colello, he feels that this theme can be just as transformational as the dawn of the internet. But I really think that the number of companies that will be significantly more profitable because of this theme are fewer than investors really currently believe. And so that it's a relevant theme, but we have to be very careful with how we play it, which stocks we invest in. But again, as was the premise of the question, the key is determining which ones have staying power and will have a long-term impact on cash flows.
Sure. I mean, this would be my last question, but then as time changes, so does a narrative that actually describes all of it. So relying solely on traditional evaluation criteria may have limitations explaining the new emerging ones. So I'm curious to know how actually Morningstar views the phenomenon. And so do you think the moat approach is still relevant, or could it move out of step with the market over time? Or how do you try to keep the multi-index methodology relevant to the current market?
Yes, it's a great question. We think that the economic moat methodology is timeless. We believe it will remain relevant very long into the future. And there are a couple things to note there. First of all, I'll say it again, it's a forward-looking methodology. And so, we're always able to sort of try to, through a research-based approach, look into the future and determine how the sands of the investment landscape are shifting. And we can, of course, change our economic moat ratings as new themes develop and as the market changes, as market conditions change, as investor sentiment changes. And so that forward-looking element helps us sort of always see where the ball is going as opposed to where it is right now. So this is the Wide Moat Focus Index certainly is not a value strategy. Sometimes it leans a little bit more towards growth. Sometimes it leans a little bit more towards value. It all depends on where we're seeing attractive valuations. But I would just reiterate, the forward-looking nature is key, and then this is a balanced strategy over time. It tends to have both growth exposure and value exposure.
Yeah, I mean, that was really a great discussion, and I do believe that Korean investors got more time to understand all these beautiful concepts of Morningstar that has established. So thank you, Andrew, again. And maybe any last words?
No, I just appreciate all the interest. I think the Morningstar Equity Research Team does a fantastic job applying these concepts, and it's been a very successful index over the long term. Thank you so much for having me and for letting me speak with the Korean investment community.
Okay, great. Thank you.
Thank you.
Andrew.